Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're starting with some exciting news from the Greater Toronto Area, where home sales have continued their upward trajectory following a recent rate cut. According to the Toronto Regional Real Estate Board, home sales surged significantly in November. The board reported that 5,875 homes were sold last month, marking a 40.1% increase compared to the same period last year, when 4,194 homes were sold. This impressive year-over-year growth highlights how lower borrowing costs have made properties more accessible to potential buyers. On a month-over-month basis, sales rose by 1.9% from October, after adjusting for seasonal variations. This steady increase indicates a strong market response to the recent changes in borrowing costs. Interestingly, while the average selling price of homes increased by 2.6% from the previous year to $1,106,050, the composite benchmark price, which represents the typical home, actually fell by 1.2% year over year. This decline in the benchmark price is notably less severe than in previous months, suggesting a stabilization in the market. Jennifer Pierce, the president of the board, remarked on the potential for a market recovery. She pointed out that with current selling prices still below their historic peaks and monthly mortgage payments trending downward, conditions are ripe for an accelerating market recovery as we move into 2025. This sentiment reflects a cautious optimism among industry leaders who are watching these trends closely. The report also noted an increase in new listings, with 11,592 homes newly listed in November, a 6.6% rise from the same month last year. This increase in supply could further stimulate the market, providing more options for buyers and potentially easing price pressures. The Bank of Canada is gearing up for its final key lending rate announcement of 2024, set to take place on December 11th. After a series of 4 consecutive rate cuts in recent months, market watchers are anticipating yet another reduction. However, the size of this expected cut remains a topic of debate among economists. TD Economics suggests that the central bank might lean towards a modest cut of 25 basis points, which would lower the lending rate to 3.50%. This prediction was outlined in a news release by TD Bank on November 25. A year ago, the key lending rate was at 5%, as the Bank of Canada, under Governor Tiff Macklem, aimed to curb inflation. Mark Ercolau, an economist with TD, acknowledges the possibility of a larger cut, stating, "There is still the chance it could cut by 50 basis points." This reflects the high level of uncertainty surrounding the upcoming announcement, as various economic indicators are considered. On the other hand, RBC Economics spokesperson Nathan Jansen interprets current economic data as pointing towards a more substantial cut. He notes, "The GDP numbers should help to reinforce that interest rates are higher than they need to be to maintain inflation sustainably at a 2% rate." Jansen's analysis suggests that a 50 basis point reduction could be on the table. Back on October 23rd, the Bank of Canada had already made a significant cut, reducing its key overnight lending rate by 50 basis points to 3.75% from the previous 4.25%. This rate serves as a benchmark for mortgage and loan companies when setting fixed and variable interest rate levels. At that time, Governor Macklem indicated that further reductions could be expected if inflation trends remained consistent with forecasts. As we approach the December 11th announcement, all eyes will be on the Bank of Canada's decision and its implications for the economy. The next monetary policy report is scheduled for January 25th, 2025. Which will provide further insights into the bank's strategy moving forward. As we look ahead to 2025, many Canadian homeowners are facing a significant financial milestone. According to the latest report from the Canada Mortgage and Housing Corporation, 1.2 million mortgages are up for renewal in the upcoming year. This is particularly notable because 85% of these mortgages were initially signed when the Bank of Canada's interest rate was at or below 1%. Now, these homeowners are preparing to renew their mortgages at what are described as significantly higher interest rates. The Bank of Canada has made a series of 4 consecutive cuts to its key interest rate in 2024, with the rate currently at 3.75%, down from 5%. This reduction has been part of an effort to keep inflation within the target range of 1 to 3%. However, this is still a considerable jump from the pandemic-era rates of 0.25%, which many homeowners benefited from when they first secured their mortgages. The Canada Mortgage and Housing Corporation report highlights a growing concern over mortgage delinquency rates, which have increased to 0.19% in the second quarter of 2024, up from a record low of 0.14% in 2022. This rise in delinquency rates is echoed across other financial products such as auto loans, credit cards, and lines of credit, indicating potential future challenges for mortgage holders. Despite the increase, mortgage delinquency rates remain below pre-pandemic levels and are still lower than the averages seen since 1990. However, the Canada Mortgage and Housing Corporation expects these rates to climb further in 2025 as more mortgages come up for renewal at higher rates, putting additional financial pressure on households. The agency underscores that household debt continues to be a vulnerability for the Canadian economy, with mortgage debt growing faster than inflation. This is particularly concerning as a large number of mortgages are scheduled for renewal in 2025 and 2026, potentially exacerbating financial challenges for many Canadians. The recent study conducted by the Residential Construction Council of Ontario, RESCON, has revealed that taxes now make up a significant portion of the cost of new homes in Ontario. In 2024, taxes account for nearly 36% of the total price of a newly built home in the province. This means that on an average home priced at approximately $1,070,000, around $381,000 is attributed to various taxes and fees. These include income taxes, corporate taxes, sales and transfer taxes, as well as development charges and fees. The study highlights a concerning trend, showing an increase from 31% in 2021 to 36% in 2024. This 16% rise indicates what RESCON describes as a worrying escalation in the tax burden on new homes. Richard Lyle, president of RESCON, expressed concern over these rising costs, stating that they are pushing new housing prices beyond the reach of many working families. He emphasized that this growing tax burden contributes to the housing crisis by impacting developers' ability to invest in new projects. Lyle pointed out that municipalities often increase development charges to fund infrastructure, adding to the cost burden on new homeowners. He called for higher levels of government to play a more active role in funding public infrastructure at the local level. For instance, the development charge for a single-family home in Toronto has surged by 993% since 2010, now standing at $141,139. The study also reveals that governments now collect 4 times more revenue from the sale of a new home than builders do. This is causing additional challenges for the residential construction sector. Specifically, 70% of the $381,000 in taxes comes directly from fees on the home, such as development charges, while the remaining 30% is derived from income and corporate taxes paid during the construction process. Regional variations exist, with the Greater Toronto Area seeing slightly higher tax percentages. For example, 37% of the price of a large apartment in the area goes to taxes. In contrast, Ottawa sees lower percentages, with taxes accounting for 35.2% of the price for a single-family home. This discrepancy highlights the uneven impact of the tax structure across different regions and housing types. Moreover, the study notes that development charges apply uniformly based on unit type, regardless of property value or size. This means that more affordable homes bear a disproportionate tax burden, which can be particularly challenging for first-time buyers and lower-income households. For instance, a $450,000 home has taxes making up 45.2% of its price, significantly impacting affordability. In response to these findings, Lyle has called for immediate reforms to the taxation and fee structures affecting new housing. He argues that economic success is closely tied to a robust housing supply, and addressing the tax burden is essential for incentivizing more home building. Without changes, municipalities will continue to pass infrastructure costs onto new homeowners, further complicating efforts to improve housing affordability. Today, we're turning our focus to a significant enforcement action taken by Ontario's financial services regulator, the Financial Services Regulatory Authority, commonly known as FSRA. On December 3, 2024, FSRA issued a notice of proposal against Viviana Prentice, a licensed mortgage agent in Ontario. The regulator alleges that Prentice violated Section 4.1 of Ontario Regulation 187/08 by receiving remuneration from a person other than her brokerage. This alleged breach of regulation has led FSRA to propose the revocation of Prentice's mortgage agent license. In addition, the authority is looking to impose administrative penalties totaling $50,000. These actions underscore FSRA's commitment to maintaining the integrity of Ontario's financial services sector and ensuring that all agents adhere to established regulatory frameworks. Viviana Prentice has responded to the proposal by requesting a hearing before the Financial Services Tribunal. This move indicates her intention to contest the allegations and the proposed penalties. The tribunal will provide a platform for both FSRA and Prentice to present their cases, ensuring that due process is followed in this regulatory matter. FSRA's enforcement actions are part of its broader mandate to protect consumers by monitoring and ensuring compliance within the financial services industry. The regulator actively investigates potential breaches and takes necessary action to uphold standards, which includes revoking licenses and imposing fines when violations occur. For those interested in learning more about FSRA's enforcement activities, the regulator maintains a comprehensive enforcement database. This resource allows the public to view ongoing and past enforcement actions, highlighting FSRA's efforts to safeguard consumer interests and promote transparency within the industry. For media inquiries related to this case, Russ Courtney, the Senior Manager of Media Relations at FSRA, is the point of contact. He can be reached at 437-225-8551 or via email at russ.courtney@fsrao.ca. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.